Welcome, everyone. It feels like we're all trying to swim through this ocean of information, doesn't it? Trying to stay ahead.
It really does. Overwhelming is sometimes the word.
Exactly, which is why we're here. We're going to try and cut through some of that noise today.
Right.
You've probably seen the tech stocks, even the big ones, taking a bit of a hit recently.
Mm-hmm. The Magnificent Seven haven't been immune.
Right. So today we're focusing on two of them, Apple and Meta platforms.
AAPL and Meta. Got it.
We're digging into an analysis from the Motley Fool. They're asking, after these sell-offs, which one do Wall Street analysts think has more upside?
An interesting question, especially with things like President Trump's tariff still kind of lingering.
And those whispers about a possible recession, yeah, all factoring in.
And didn't that Roundhill Magnificent Seven ETF take quite a tumble this year? Something like 18% down.
Yeah, close to that, which sets the stage perfectly, right? Investors are looking for where the value might be, even within that top group.
Makes sense. They want to know who might bounce back stronger.
Precisely. So our mission here is to pull out the key insights from this Fool analysis on Apple and Meta. What's shaping their potential?
All right, let's do it. Where do we start? Apple.
Let's start with Apple. The report really highlights the tariff situation as a key factor affecting the stock.
Well, yeah, they make, over 80% of their stuff in China? So tariffs are a direct hit.
A huge dependency.
Yeah.
And the potential costs are, pretty staggering.
There's that Wedbush analyst, Dan Ives. He estimated an iPhone made in the U.S. could cost, get this, maybe $3,500.
$3,500 for one iPhone.
I know, right? It really underscores the economics of their current setup.
It's not just the final phone either, is it? The report mentions shifting just like 10% of the supply chain stateside.
Mm-hmm. Ives put a number on that, too. Around $30 billion over 3 years.
$30 billion just for a tenth of it. That's massive.
It really shows you the scale they operate on and, the efficiency they've built internationally.
So what's the actual deal with the tariffs on China right now? The article mentioned higher rates are still there, but a temporary exemption.
Yeah, that's an interesting point. The higher rates, like 145% on some things, remain. But smartphones and some electronics got a temporary pass.
Temporary. What does that signal?
Yeah.
Hope for a deal or just kicking the can down the road?
Well, you could read it either way, couldn't you? Maybe it hints at future talks, a more nuanced approach.
Or maybe it's just delaying the inevitable pain.
Possibly. The temporary part is key. It creates uncertainty, and businesses really don't like uncertainty when planning big investments.
Okay, so given that uncertainty, what are analysts like Ives saying about Apple's earnings? What's the forecast?
His base case, sort of the middle ground, is for a 10% earnings decline for Apple in 2025 and 2026.
Okay, a 10% dip?
But, and this is the key variable, if there's no trade deal, no lasting resolution.
Then what?
The worst case scenario he outlined is a drop of maybe 15% to 20% in earnings.
Oof, that's a much bigger hit. Quite a range of possibilities then.
Reflects the situation perfectly, doesn't it?
Yeah.
Very unpredictable.
But even with these tariff concerns, it's not all doom and gloom from analysts, is it? The overall sentiment seems okay.
That's right. Looking at the past 3 months, the report counted 33 analysts covering Apple.
And the breakdown.
17 had buy ratings, 13 were hold, and only 3 said sell.
So more buys than holds or sells combined. The majority are still leaning positive despite the risks.
Exactly. The concerns are there, but they still see underlying strength.
And in terms of price targets, what's the average expectation for upside?
The average target price mentioned was around 238 times a share.
Which, based on prices, when the article came out, implied, about an 18% upside?
Roughly 18%, yeah.
So even with everything, you've still got that iconic brand, the strong balance sheet.
Right. And the potential for AI integration. That's a big factor people are watching.
Mm-hmm. And valuation-wise, where does it stand?
Trading just under 28 times forward earnings, which, interestingly, is pretty close to its 5-year average.
So not necessarily cheap, but not wildly expensive compared to its own history.
Pretty much in line, yeah.
Okay. Let's switch gears then. Meta platforms. Completely different story regarding tariffs.
Yeah, largely. Since Meta is all about software and ads, not physical goods, those direct supply chain tariff issues don't really apply.
Okay, so no manufacturing headaches, but what about a recession? That's got to be their potential vulnerability, right? Ad budgets.
That's the conventional thinking, absolutely. Marketing is often one of the first budgets to get squeezed in a downturn.
Makes sense. Companies pull back.
But there's a counter-argument mentioned. Morningstar analyst Malik Khan thinks Meta might actually be more resilient.
Oh, How so?
His point is that Meta's platforms are seen as offering a high return on ad spend. So when budgets get tight,
Companies might prioritize the platforms that give them the most bang for their buck.
exactly, they need every dollar to count, and Meta's targeted ads could be seen as more efficient, making it a priority spend even in a slowdown.
Huh. That's actually a really interesting take, a potential buffer.
It is something to consider.
So, okay, how are analysts feeling about Meta overall then, compared to the mixed but positive view on Apple?
It's significantly more positive for Meta. Overwhelmingly so, actually.
Really? How many analysts?
In the last 3 months, 46 analysts put out reports.
46. Okay. And the ratings?
Get this, 42 had buy ratings.
Wow, 42 out of 46.
Only 3 holds and just 1 single sell rating.
That is a very strong consensus. Very bullish.
Extremely bullish, yeah.
And does that translate into a higher potential upside in their price targets compared to Apple's 18%?
Oh, yeah. Significantly higher. The average price target for Meta was around $726.
$726, which implies what kind of upside from the time of the report?
About 39% potential upside.
39%. Okay, that's more than double Apple's projected upside.
Correct. A substantial difference in analyst expectations right now.
And what's driving that huge optimism? Is it mostly about AI?
AI seems to be the massive factor here, yes. Analysts see Meta as a prime beneficiary.
How specific?
Mainly in making their advertising even better. Improving the targeting, improving how they measure results.
Right, making the ads more effective, which means more money.
Exactly. Conrad van Tienhoven at River Park Capital was quoted saying, Meta is maybe the biggest beneficiary of AI after NVIDIA. He sees it driving faster growth, higher revenue per user.
Because the AI can crunch all that user data and deliver hyper-relevant ads.
Precisely. But it's not just ad targeting.
Oh, what else?
The article mentioned AI helping with better data analysis generally, finding deeper insights, maybe automating parts of the ad buying process too. More efficiency.
So AI is kind of woven into their whole operation, boosting both the top and bottom lines potentially.
That seems to be the thesis, yeah. And valuation-wise, similar to Apple, it's trading around its historical average.
What was the number?
Roughly 20.8 times forward earnings. So again, that big upside projection isn't just based on assuming the stock gets a much higher multiple.
It's based on expected earnings growth, fueled by AI.
Seems to be the core idea, yes.
Okay, so bringing it all together, the core question in the Motley Fool analysis, Apple versus Meta, which has more analyst projected upside right now.
Based purely on the analyst consensus data presented in that report, the answer is pretty clear.
And that is?
Meta platforms.
Yeah.
With that projected 39% upside compared to Apple's 18%.
Right. And the key difference boils down to Apple's tariff risks versus Meta's AI opportunities.
That seems to be the main divergence highlighted. Apple's wrestling with these external geopolitical pressures on its physical supply chain.
While Meta is seen as potentially riding this huge internal wave of AI advancement, particularly in its main business, advertising.
That sums it up nicely.
Now, we absolutely have to add the usual disclaimer here, don't we?
Oh, definitely. It's crucial for listeners to remember these are analyst opinions, price targets. They're educated guesses, informed projections.
But not guarantees, not crystal ball.
Absolutely not. The market has a life of its own. Things can change fast. The tariff situation could shift again. The economy could do something unexpected.
Right. So many variables still in play. Treat these targets as data points, not certainties.
Exactly. Important context.
Okay, so let's just recap the main takeaways from this deep dive then.
Sure. Apple, facing some real headwinds from tariffs impacting earnings forecasts, but still has immense brand power, a solid foundation, and AI potential as a long-term plus.
And Meta. Less direct tariff exposure, looking positioned to really capitalize on AI and advertising, leading to much higher near-term upside projections from analysts.
It covers the core findings of the analysis.
Which leads us to maybe a final thought for you, the listener, to ponder.
Yeah.
We've talked about tariffs, recession risks, AI, all based on this analysis. But how do these very different business models, Apple's hardware focus versus Meta's digital platform, and their different exposures, how does that shape your view?
Beyond just the analyst numbers we discussed.
Exactly. What other factors, maybe things not even mentioned here, competitive pressures, regulatory changes, future innovations we can't foresee, might actually be the most critical things determining where these two giants go in the long run?
That's a great question to leave people with. Lots to think about beyond the headlines and price targets.